Hello traders and potential future traders, Patrick Maldonado here, cryptocurrency trader and market analyst at Alpha Chain Capital and creator of TCE Trading. So in today's episode I will be talking more about backtesting and forward testing. This is an important step in trading as you want to evaluate your strategy to see if it might be profitable in the long run. So guys, I hope that you've been doing great. I hope that you are having a nice day, hopefully a nice week. If you're listening in Thursday, well, the weekend is almost here, so let's just get into the topic because I want to talk about the importance of backtesting. So if you are into trading, if you have already listened to the previous podcasts, or if you have done the AB trading course, you will know a little bit more about backtesting. But again, I would like to reflect, why do you think it's important to do a backtesting? From the word backtesting, you are basically testing your strategy with previous or back in the past, right? So right now I'm imagining that you're closing your eyes and you're really reflecting, why is it important? Now, if you don't know, the importance is that first you want to know if your trading strategy works, right? You don't want to go into the market without having something that you are aware that might work or have a good probability of working. You don't want to go into YouTube and find, a random guy saying, yeah, this is the trading strategy that I have, and it's very profitable, so that you use it, and then after a couple tries you find out that, yeah, well, it might be profitable. In some cases it's very difficult to have a good entry. Also, what you want to know is to have a better feel for the market using a particular strategy, and that's why this is very useful. Backtesting really assesses the viability of a trading strategy by discovering how it would play out using historical data. And it's important to mention that it's historical data because historical data is in the past. And you already know that past performance is not really indicative of future results. So have that in mind when going forward. In any case, if you have, a positive backtesting, if you have a backtesting that shows promising results, then you might be more confident and employ it in reality. Right, that's really when a lot of the uncertainty in trading and in the trading in the different financial markets go away. That's when the uncertainty go away, because now you have a trading plan, now you have your backtesting, now you are more confident on what you have been doing, so that you can actually start trading and potentially be profiting. Now, let's talk a little bit about the backtesting analysis. What are you trying to analyze? So first of all, and we have talked about this before, is the win-lose ratio or the win percentage. Why is this important? Of course, you want to know with your trading strategy, what's the edge that you have on the market, right? If you have a 50% chance of winning a trade, that's huge. Now let's take a look at the average risk reward ratio, which we have already talked about in previous episodes. You want to take into consideration these two metrics, because if you have a good win-lose or win percentage of about 50%, then you know that you have to have at the very least a 1.5 maybe average risk-reward ratio in order to profit in the long run. So these two metrics are going to be very important for you to take into consideration. Now, you also want to see what could be your potential gains versus maximum drawdown. Now, this is really for you to kind of assess again and take out a bit of uncertainty, because if you backtest a strategy for, let's say, 100 trades or more if possible, then you might potentially understand what the potential gains might be, but also what the potential maximum drawdown is going to be. So for instance, if you are losing, I don't know, 2-3 trades, or maybe when you look at your equity graph, it's going to be down for, let's say, 5%. which might be a lot depending on how you're trading, but maybe it's 5%, and you see that after testing, that's the maximum drawdown, or that's the kind of like the lows that you have while profiting. So that might be very good. That might give you a very good understanding that if you have that drawdown, you still have to be confident about your backtesting and about your strategy, because that's kind of like normal. So you eliminate a bit of uncertainty in that. Now, something that I did and I worked, you have no idea how many hours I put into the TCE trading templates, not only for risk management, for back testing, and also for the trading journal. I mean, these kind of templates really tell you all of these metrics, and you basically just fill an Excel spreadsheet and it calculates everything for you. Of course, you can obtain this if you go through the AB trading course, both in Udemy or in my platform. But this is something to take into consideration, because you need something to calculate all of this. You need something to really store all of what you're doing with your trading strategy, with your backtesting, and so on. Now, what types of backtesting are there in trading? So there's basically two, and this is coming back to what I mentioned in previous podcasts about being mechanical traders and discretionary traders. Because if you have a mechanical approach in backtesting, you are only taking a look at indicators or at specific things that might trigger when taking a trade. Let's say, for instance, and we have discussed this before, but maybe you are trading, I don't know, pivot points with RSI, and your strategy is whenever the pivot point reaches, I don't know, R2, S2, whichever you want, and the RSI is oversold, overbought, I'm gonna take a long or short, depending. So this is something that you can literally just go back into the charts and look when this happens, when this specific thing or metric happens, I'm gonna take a trade. So you can go into the historical data and start putting mock trades in order to see, okay, this is what might happen or not. Now, discretionary trading, or the discretionary approach to backtesting, is a little bit different, because what you want to do is not only rely on the mechanical side, saying that if this happens, I'm gonna do this, but you also want to put yourself into test to have a feel of the market. And this can be easily done. A lot of trading platforms, chart platforms, allow you to go into the past or the historical data and remove all future candles. For instance, this is called bar replay in TradingView. So you can go back into, I don't know, the beginning of the year, and it will remove all the future candles, and this will help you to remove hindsight bias. Why is this important for discretionary backtesting? Is because you are not only testing your trading strategy, but you are also testing yourself, because you don't have hindsight. So if you're a discretionary trader, this might be a very good tool for you to use. I have been talking about historical data, and this is why backtesting is a thing, but it's not the only type of testing. You also have what is called forward testing. So what's the difference? Backtesting, as its name says, it uses historical or past data. That's why it's back, because it's in the past, and you're gonna use whatever data you have available in order to improve your trading strategy. Now, forward testing is different, because forward testing is basically a simulation of actual trading, or the same simulation using unknown data. And this is very important, because I will explain the difference between backtesting optimization versus forward testing with unknown data. Now, backtesting optimization means that maybe you go into the last, I don't know, it's 2020, so maybe you go into the beginning of the year, and for the first 6 months you apply your strategy, and you see that you have a particular set of results. Now, you can try and optimize your backtesting or your trading strategy so that you can improve your results. This is something valid. But if you are optimizing the first 6 months of trading in, I don't know, 2020, and you have better results, you still have not traded that in a real environment, okay? Now, there's two ways of using forward testing in this. The first one is, real trading with a demo. So you are basically gonna open a demo account and you are gonna be trading your trading strategy to see if it works. That's kind of like the first use case of forward testing. So if you get good results in the long term, then you can potentially use that strategy and be profitable uh, for different trades. Now, what you can also do is, instead of doing that that forward testing, and because it can take a lot of time if you're doing forward testing, it can take days, weeks, even months if you are really trying to wait for each setup that might happen. The other thing that you can do is that, if, for instance, with the same example, 2020, you grab the first 6 months of the year for your back testing, you leave the other amount of time to the current time. If we're talking about, again, starting from 2020 or the beginning of the year until 6 months, then you can use the data after those 6 months to today's date in order to use as forward testing, because that's data that you have not tested, right? That's the data that you don't know, that you have not used to optimize your trading strategy. So that's a very valid kind of set of data in order to do forward testing. And of course, if you optimize it with your back testing with previous data, and then by using this new data you achieve good results, then you might be on your way of having a potential profitable strategy. In any case, traders and listeners, I hope that you enjoyed this episode of the TCE Trading podcast. Backtesting is an essential part of trading, as it will help you be more prepared and confident with your trading strategy. If you would like to start learning how to trade, get a 30+% discount with the code TCE Podcast on my AB trading course in Udemy. Thank you very much for listening, and I will see you in the next episode. Take care.